Hello, everyone. Thank you for joining us today. I'm John Laboda, a member of the class of 2002. I'm an executive with Carrier Global Corporation and lead the legal, strategy, and M&A functions for Carrier's commercial fire and control businesses. Carrier is one of the world's leading providers of healthy, safe, and sustainable buildings and cold chain solutions. You may know Carrier as the inventor of modern air conditioning. I'm also a member of the university's alumni board, a group comprised of 25 members that represents each of the university's schools with the purpose of engaging all alumni and students in a lifelong connection with one another and with the university. Today's lecture is part of a series that was launched back in April of 2020 called Experience Rochester, that exemplifies the university's commitment to lifelong learning. The series features topics and speakers unique to the university. We have a wide range of registrants joining us for this session, from friends of the university, parents, current students, and to alumni from as far back as the class of 1955. Before we get started, I wanted to let each of you know that a recording of today's session will be made available for the audience early next week. Now, I would like to introduce today's speaker. Yen Bai is a professor of economics at the University of Rochester and a research associate at the National Bureau of Economic Research. Her research focuses on macroeconomics and international macroeconomics. Chun Liu, today's moderator, is a third-year PhD student in the University of Rochester's Department of Economics. Her research interests include international macroeconomics, sovereign default, and international finance. She will join Professor Bai after her presentation for a moderated question and answer session. You can submit questions to Professor Bai in the Q&A box at the bottom of your screen. Thank you again for joining us today, and I will now turn today's presentation over to Professor Bai.
Hello, everyone. Thanks a lot for joining me today, and it's great to see so many alumni. So what I'm gonna have today is I will talk for 20 minutes, and then we're gonna have the Q&A session. So the topic I will give today is the global debt crisis, COVID-19 in emerging markets. So let me start to define what are emerging markets. Those are the countries, they are not developed countries, but these are fast growing countries. And they actually has become more and more engaged in the global markets as they grow. And so the typical emerging markets include the Latin American countries and Russia, China, India. So the COVID-19 definitely presented challenges to all the countries, but this is especially difficult for emerging markets due to their limited policy tools. And because of that, they will gain a lot from international debt relief program. At the end, I will talk quickly about recovery and the role of vaccine in their recovery. So let me start with this picture of the death toll in emerging markets. The right-hand side of this picture shows the daily new confirmed COVID-19 death per million people. I put some typical emerging markets. I know that it's very hard to see which is which, but I think the takeaway is there are basically two waves, like what we see in the US. Another thing is, if you look at the world, the highest COVID-19 death toll happened for the top 4 countries. We have 3 of them are emerging markets, Brazil, India, and Mexico. It's also very likely that there are actually more, there are many more actual deaths than what we see. So I remember that in the last August, the New York Times actually, they compiled this excessive death relative to official death. So for example, for Turkey is about 2, and for Ecuador is about 15. So the actual deaths can be more than what we see in this picture. And then to deal with the COVID-19, emerging markets like the advanced economies, so they put lockdown policies, and agents, residents also adopt social distancing. Okay? So you see the right-hand side picture. This is the data from Google Mobility. Okay. It shows the change of workplace traffic since the COVID-19. Okay. And then you can see that is in the last April, there's a dramatic decline in the workspace traffic. Okay. So for many countries, it's probably declined as more than like a 50% workplace traffic has a dramatic decline. And even right now, back to yesterday, there's still lots of countries, their workplace traffic haven't coming back to the trend yet. Okay? I mean, this is a picture we will also see in the advanced economy. Of course, it doesn't mean that this decline in the workplace traffic is one-to-one mapped to the decline in hours, because of the you can work from home. Like me, I most of the time work from home. But then for emerging markets, this is in particular severe because only a very small amount of jobs they can work from home. So that's one challenge they're facing. The second thing is, on top of this decline in the working activities, they also face a lower trade and lower tourist demand coming from the developed countries. And at the same time, they also face a lower remittance. Everything everything added together, that just implies that the GDP growth for this country is very low. So that's the picture from IMF. It shows the GDP growth for 4 category countries. The first one, the blue bar, that's the advanced economy. The second one, the right one, this is the emerging markets, all the emerging markets. And the green one is the one excluding China, because we know that China, with this strict lockdown policies, is already recovered. And you see that it is the case that emerging markets, because all the difficulty they're facing, the lockdown, the lower international demand, so that make them face very deeper recession. And looking forward, so IMF also makes some predictions over the GDP growth for 2021 and 2022. And you can still see that the green bar is still very low. Okay. The advanced economy is probably almost coming back to their pre-pandemic level, but the emerging markets, they're still doing badly. Even 2022 is probably about 6% of below trend. So by facing this difficult time, usually that we see that countries will adopt both either monetary policy or fiscal policy, or both of policies, to help the economy to survive the bad time. Like in the US, we see this large stimulus plans trying to help over small business and unemployed workers, or the monetary policy is the Federal Reserve Bank trying to maintain the low interest rate to help the economy. Well, similar thing can happen in emerging markets, but actually it's very difficult. For one thing is, if we think about monetary policy, they can lower the interest rate, but then they definitely face this risk of high inflation. And those are the countries, emerging markets are the countries in the history, they already has this hyperinflation history. And the central bank is only recently, since 2000, they start to gain the independence. And so they're trying to keep inflation targeting, trying to maintain their reputation that I can commit to my policy, to my inflation target. I try not to raise the inflation to dilute my debt. Okay? So that will make them very hard for this time to increase, to lower interest rate, and then to generate this high inflation pressure. So that's the challenge they face in the monetary policy. At the same time, what about fiscal policy, right? So typical textbook will tell us that if a country in bad time, the country should borrow. Or as an individual consumer, is similar thing is, when I face a bad time, I should borrow to help me to survive this difficult time. But then when we think about emerging markets, lots of emerging markets has this recurring debt crisis historically. For example, we see this in 1980s, the Latin American debt crisis. Almost all the Latin American countries have been defaulted. And if you think about Argentina, this is like a serial defaulter, we call it, right? So it defaulted in 2001, 2014, and it's actually last year, after the COVID-19, Argentina also defaulted. Mexico, tequila crisis, Ecuador. So with this all recurring debt crisis, lenders will be reluctant to lend to those countries. So that will make the countries face a very limited borrowing capacity, which also means that with the limited borrowing capacity, they can't really, they face this limited physical space to help their residents to survive this COVID-19. Okay? So as a matter of fact, we actually see a rising debt burden and increase in debt service cost during or after the pandemic. Okay? Just to tell you how difficult they're facing in terms of their borrowing capacity. So I take this picture of, this is the daily CDS spread. What is CDS spread? It basically measures the default risk of a country. It also reflects, if they want to borrow, how large is the borrowing cost. The x-axis, the y-axis, this is the basis points. Or you can think about the 300, it's like 3% of our actual 3% of borrowing cost. Okay. So in the last, during the pandemic, almost all emerging markets, they face an increasing spread or increasing borrowing cost. Okay. As a matter of fact, actually the Ecuador and Argentina, they actually defaulted in April and in May. And that's why their spread is on the right-hand side, because in forecast, they are about to default. The investors charge a very high spread when they think about to lend to those countries. So this picture was shown that is that during this pandemic, the country is supposed to borrow to help them survive the pandemic, but then they actually face a very high borrowing cost. So that makes them very difficult to do the lockdown policies. But of course, you may say that this we actually observe the decline in the sovereign spread because the IMF and also the World Bank and the international institutions, when they come to help, we already see that the decline in the spread. But I'm going to show you a little bit that the debt burden actually still very high. So why, like again, why is so important about the financial markets? Why the default risk is so important? Okay. So I have a recent work with my co-author Cristina Ariano from Federal Reserve Bank of Minneapolis and Gabriel Mihalacci from Stony Brook University. So we actually can build a model and we conduct some counterfactual. Okay. I just want to tell you that this is the total number of diseased of death toll forecast final model. So we can see that from here is if there's an increase in default risk, and that means that the borrowing cost will be high because lenders, they will charge for a higher borrowing rate to compensate their the losses in default risk. And that's literally limits the amount the lockdown this country can do, and that would generate a large death toll. So in the end, if we consider this model with default risk, we're gonna see that in total will be a loss for 0.15% of population. So how large is that? If we think about Brazil, for example, Brazil, the total population is about 200 million people. And 0.15% of that is almost like 300,000 people. That's in the ballpark of how much deaths we see in Brazil. Okay? What if these countries, they actually can commit to repay their debt if there's no default risk? In that case, this is the case we call the perfect financial market. Then we can reduce the debt by 2/3. So in the end, that will be only about 0.05% of population will be in the debt toll. Why that's the case? The whole reason is because if the country can borrow, okay, then they actually can they can support more lockdowns. So the second picture we see here, this is a lockdown. So if they can lock down by like 80% of their population in early April, then that will actually help a lot of in reduction of their net death toll. Okay? So go to the extreme case, if they cannot borrow at all, you can see that the total debt will go up a lot. Okay? The whole reason is because it's very costly to do the lockdown. Even 40% lockdown in a financial autarky case could imply a dramatic decline in their total consumption. So, and then making lockdown is just very costly. So what this picture just shows that why the debt crisis or the potentially the limited physical capacity in terms of borrowing can be very harmful to emerging markets. So can really exaggerate, it can really make it really bad, the health crisis. And then again, as I said, when we just saw that, it seems like the borrowing cost of the country has declined. So maybe we shouldn't worry about too much about it. Okay. So this is a picture I'm going to show you what's the total debt look like in emerging markets and developed and the advanced economy. So we have two lines over here. The purple one is for the advanced economy. The red one is for the emerging markets. Okay. And I'm sure that, so the bar we have here is oil crisis, Asian financial crisis, global financial crisis. Okay. You can see that during the global financial crisis, there's dramatic increase in the total debt. Okay. And similar thing for here is, so the last two dots are for this COVID-19 crisis. Okay. Just right after the crisis, there's a dramatic increase in the total debt over GDP for both emerging markets, for both advanced economy and emerging markets. And it seems like this increase in debt is more for advanced economy, less for emerging markets. So that may make people think that, oh, we probably shouldn't worry so much about emerging markets. Maybe the debt is not a big deal because advanced economy actually face a much larger increase in debt, and the level is much higher. So it's a little bit misleading in that sense, in the sense that first, advanced economies, given their low risk in terms of default, they actually face low interest rate. So remember the sovereign spread I was showing for you, that's actually relative to what developed countries are having. So advanced economy in general, they face low interest rate. So the increase in debt probably means that the increase in debt burden is actually not so much given the low interest rate. The second thing is, in the history, just because of this frequent default in emerging markets, the debt intolerance is different for advanced economy and for emerging markets. For example, Argentina defaulted on its debt. It's probably about 30% of GDP, it defaulted. But if you think about Japan, for like a decade, Japan has like a debt over GDP more than 100%. We didn't see Japan defaulted. So the level, I want to say the level for the debt intolerance for advanced economy is actually much higher than for the emerging markets. The 62% is probably already a very high number. Okay. Or another picture we can see is for the debt servicing cost. So by debt servicing cost is the total interest payment and the principal payment within each year. Okay. So here, this is a picture I take it from IMF. They listed for some advanced economy and some emerging markets. And you can see that one example is South Africa. Okay. There's a very fast increase in the debt service cost. In fact, they actually forecast in 2030, the debt service cost is about 14% of GDP. India is about 8%, Brazil is also about 7%. And relative to the US, with a very high debt over GDP, the debt service cost is only about 6% of their GDP. Okay. It definitely varies across emerging markets. Like Mexico is probably only about 5%. But this also shows that for some emerging markets, this debt service cost can be very high and grow very fast. And that potentially it implies a high risk of default in the future. Another thing is, of course, what we talk about I was showing more is about external debt. What about the domestic debt? Who are holding the domestic sovereign bond? So in the past, as I just said, that the central banks, lots of central banks, they gain their independence and then they target inflation. And so that will make them be more, people trust them more, and so they can issue more local currency debt. Okay. So this is a picture of the composition of domestic sovereign debt holdings. The blue bar, first thing is the majority of the domestic debt is in local currency, means that the central bank actually can inflate away if they want to, okay? If they can use inflation to reduce their debt holdings. Okay? So the blue bar over here, this is for non-residents. So since COVID-19, we see actual capital flow out of the country. So the non-residents holding less of or negatively of the domestic bond. The very striking one is the red bars. Those are the debt holdings by domestic banks. So after the COVID-19, the domestic banks actually absorbed the bulk of the increase in domestic debt, and that has a very has an implication that is either if the country defaulted, if the government defaulted on its local currency debt, which happens in the history, or if the central bank inflate away this debt, that implies that the bonds that will dramatically reduce the bank's value. And if the banks has a decline in their bank's value, will they through the balance sheet effect, they probably cannot lend to the private economy. And then firms, if they have to borrow from the banks to finance their working capital or finance their investment, this just implies that potentially we may have this risk of domestic recession coming from these bank channels. Okay? So potentially I want to say is for emerging markets, given their debt issues, they could face a default. That's very bad for the economy, because in the history we see that a sovereign default usually links a recession, a large unemployment, and very slow recovery. And second thing could be that is given this a lot of domestic banks hold a lot of domestic debt, it could also happen through the domestic channel that when the sovereign default or when the central bank put high inflation, that would reduce the bank's value, and that could also happen through the balance sheet channel that the private economy will face a tightening of the credit. So we may see a credit crunch in the emerging markets. Okay, so another thing is about China. I mean, China is one of the largest emerging markets. It may feel like China may be okay, right? Because it's already recovered quickly, very rapidly. This is a picture I taken from the IMF Global Financial Report. So what it shows us over here is, even the overall looks okay in China, but however, the domestic debt actually also becomes more risky and vulnerable. This shows the bank's credit spread. Okay? So the y-axis, this is the basis point. Okay? And you can see that is after the pandemic, there's a dramatic increase in the bank credit spread. So that also shows the potential risks. Okay, now let me tell you about it. So given all those a large debt burden and debt service cost, and potentially we face this debt crisis, global debt crisis, how can IMF or World Bank help? Okay. So suppose we have these international institutions will grant, say, 10% of loan to GDP with low interest rate. Okay. Remember that on average right now, the debt over GDP is about 60%. Okay. If those emerging markets will receive a 10% loan to GDP, doesn't have to be free, as long as it's a low interest rate and the country will commit to repay. In this case, we actually can see that the debt crisis can be reduced by 2 years. And it will also reduce the debt toll by 2.1%. And overall, the country will gain by 7.5% in terms of the country's GDP. Lender will also gain from it. Lender can gain by about 5% of the borrower's GDP. Okay. Why both? I mean, both the countries and borrower will gain from this international relief program. The reason is because COVID-19 is really an unexpected shock. Okay. So no one predict that we're going to have a COVID-19. So in this case, if the country defaulted, then the lender will also subject to loss. So then an international relief program will help the country to repay their debt and reduce the risk of default. Then the lender will also gain from it. Yeah, so this one just shows what's the social value of the debt relief program. Another thing is about the vaccine in emerging markets. Okay. So I guess you guys probably all know this, that is the vaccine campaign against COVID-19 in many emerging markets have lagged behind. Okay? What they have over here, the right-hand side, this is the share of people who received at least one dose of COVID-19 vaccine. Okay? And then you can see that most emerging markets actually are has very low level of vaccine. Okay? It's less than 20%. The one doing really great is Chile and Uruguay, but most of the other countries has a really very low level of vaccine. Okay? And then so I want to say is that we do see that the COVAX program already trying to help the emerging markets, but at the same time they definitely are running behind. Okay, so my last slide, I think we have enough time, is I want to talk about this. The further recovery, I want to say the international aids are very important. And also the even more important thing is the format. I definitely believe that the vaccine is probably more important than simply give the country money to reduce their debt. At the end of the day, why we care about this? Because if only one country defaulted, one country has debt crisis, it probably doesn't matter much for the developed countries. It would mean a disaster for the country alone. But if all the countries has issues, it's actually that will affect the global economy, not just the emerging markets alone. It will also affect the developed countries. Thank you. That's all my presentation today.
Thanks, Professor. Thanks for the nice presentation. So, and also thanks for all the questions we've got both through the registration and in the Q&A box. So we'll go through these questions in the following Q&A session. So the first question I want to ask is from Barry in the Q&A box. So Professor, do you have the number of like how many the debt over GDP for those emerging countries? Do you have the numbers?
How large is the debt over GDP in emerging markets?
Yeah, how large is the scale?
It definitely varies across countries. On average, it's about 60%.
Okay. So the next question, I think, is a follow-up questions about the role of debt relief programs targeting the emerging markets. Since Professor, you mentioned that the high borrowing cost faced by the emerging economies and the significant welfare gains of debt relief. So we got questions asking about the role of the specific debt relief programs of IMF or World Bank during those emerging market debt crises. So could you please comment a little bit more on the effect of those debt relief programs?
Okay, that's a very good question. So far, I think IMF and World Bank, I would say they acted very fast. So in last year, right after the pandemic, probably after in April, they already started this debt relief program. I think IMF probably already issued about 250 billions of debt relief. It's about a quarter of its total borrowing capacity. And similar for World Bank also roll out a very large debt relief program. Like the different countries, they vary across countries. I think for Chile, probably already received about 8% of the debt relief. And in terms of format, I think a lot of is in terms of a short-term debt and non-defaultable loans and with low interest rate. So it's similar as what I show you in the slides.
Okay, thanks for the comments. And also in the presentation, we have already seen the highway debt burdens of those emerging markets. Of those emerging markets. So we got a question from Stephen who asked about the long-term effect of these huge debt problems on the emerging economies. And do you think this effect on emerging markets will be just temporary or it will last for a long time?
Thanks a lot. I think that's definitely a very good question. Whether it's a short term or long term, I think it depends on the vaccine, how fast or how much or how many vaccine they can receive. If they can resume the economic activity very fast, then this debt is not a big issue. Otherwise, it will be a large issue for these countries. And we see from the past, a sovereign default can last very long, can last even long for a decade, like what we see in the large American debt crisis. And during the default episode, the economy will have low GDP growth, high unemployment, and take a very long time to get recovered.
Great, thanks. And we also got a question from Mark. It's like a counterfactual scenario. So the question is, what will the debt situation be for those emerging markets and these implications if we didn't get this COVID pandemic? So would you like to give some comments on that?
Yes. I show you guys the picture of this great debt spike. We do see that it is the case that we observe there's increasing debt over GDP in the past already. But I think with COVID-19, the increase in debt is very fast. There we see a very fast increase in debt. It's not so much for it's true for both advanced economy and for emerging markets. Yeah, and I think that's definitely very heterogeneous across emerging markets. Like Argentina already, I mean, doesn't have a lot of debt, but it's already in the during the risk of default. Similar for Ecuador, and the COVID-19 just make them default, fasten the process of defaulting.
Okay. So the next question is about I think it's the interaction of fiscal policy and monetary policy. This question is asking about the role of the central bank. This question is from David, asking whether the central banks should monetize debt to respond to the default risk for emerging markets.
Yes, I think that's definitely an interesting question. Should the central bank monetize the debt? I think first thing, it depends on what's the composition of the sovereign debt, because definitely a part of it. I mean, in the past, before 2000, lots of countries, the majority of debt holdings are dollar debt. Even right now, I think a big part of the debt holding is the debt is in dollar. So in that case, the central bank cannot monetize the dollar-denominated debt. But right now, I think many countries, they start to issue, or they can issue, local currency debt. Part of the reason is because their central bank commit to inflation targeting. Okay? So if right now they inflate away their local currency debt, I definitely feel like it's risky. I think the central bank alone would think that it's risky because they're going to lose of their reputation. And that means that later on, they cannot issue local currency debt anymore. So it's definitely more risky for emerging markets than the advanced economies to monetize their debt, just given their past of hyperinflation history, and they probably want to maintain their reputation. On the other hand, the COVID-19 is a very unexpected shock to all the countries. People may forgive the central bank if they want to inflate away the debt. So, yeah.
Okay, thanks for the comments. And we also got a live questions from GL. So, Professor, do you think lockdown in emerging markets would make the debt situation even worse?
Yes, I definitely think that the lockdown in emerging markets will make the debt problem even worse. The reason is for a couple of things, right? I mean, lockdown means that we lower economic activities, and the tax income will be low. So that's one thing will make the governments more likely to default. And second thing is emerging markets already have a large fraction of informal sector. Probably the government definitely want to more helping the economy get more, and so they has larger incentive to borrow to help the economy to survive, and so that would totally make the debt problem worse.
So okay, great. Let's shift gears a little bit. So we have got some questions about impacts on US and other developed countries. We have talked about the emerging market a lot, but due to globalization, so how would those emerging market debt crises impact US and the global economy?
Right. I think it's the emerging market. I think will have impact for the US. One thing is through trade. For example, Mexico and US has about like 14% of US trade is with Mexico. So if Mexico has that crisis, then that would definitely affect the trade between US and Mexico, and that will hurt the US. On the other hand, if suppose a country with not so much of trade linkages with the US, if just one country defaulted, it probably doesn't affect much for the United States. But if, again, as I said, we observe this increase in debt globally, and if the countries they can't get vaccine in a very timely order, then they probably have to do lockdown, and then their economic activity cannot resume. And if we see like many countries defaulted, that definitely hurt the global economy. Given that right now we see the larger linkages across countries through trade.
Thanks. And we also got a question from Thomas asking about the debt spending in developed countries. So how does the debt spending in the US and other developed countries compare to the debt of emerging countries we just see as compared to each country's different GDP difference?
Say it again. So you ask how the developed countries,
so,
the rich countries,
yeah, the debt spending in these developing countries compared to the debt of the emerging countries as compared to each country's GDP.
Yes, so I think the developed countries definitely has much faster expanding in terms of their debt spending. I show you guys the picture that the total debt increase, the level of debt is probably on average about 120% in the advanced economies. So that's much higher than the developing countries. Part of the reason is because, again, as I said, this is a bad time and we should borrow to help the economy to survive. And the reason they can have the so high increase in debt is because of they have the higher borrowing limits, they have the borrowing capacity, and they face low interest rate. So that doesn't seem to be a big issue right now, but I don't know what happened. It will be keep going on furthermore. If they keep have this increase in debt, what's gonna happen? We also see in the European debt crisis, even developed countries can default on their debt. For like Greece or Italy, Spain, they both have the debt issues back to European debt crisis.
So, okay, we got another live questions since I think it's a follow-up questions to our discussion on global economy. So it's about the digital yuan, since the new issuance of digital yuan. How the digital yuan will affect the global economy in your point of view?
Wow, that's a very interesting question. I think that's a yes. How will digital yuan affect the global economy? I think one thing it depends on how people accept for digital yuan. The digital currency all have it's probably has the benefit of convenience, but at the same time, it's recordable. So you can hide any transaction you want. You may not have, you may lose your privacy. That's just let me say this. I don't have I'm not expert in the digital currency. I've just experienced of my own opinion. So whether the digital yuan will be accepted, whether it become popular or have a big power in international economy, I think it depends on whether globally how people accept the digital yuan. I want to say it has the benefit. It may also seem it has its own disadvantage. The one thing for sure is the government in Chinese government can impose the local residents to accept the digital currency, but it might be hard to impose that internationally. So I think it's all depends on the supply and the demand effect. for me, I can see it's definitely convenient. And on the other hand, I think all the central banks, like the Federal Reserve Banks of the US, the Central Bank of UK, they all trying to push their own digital currency. So it will be a race internationally.
Okay, thanks, great. So I guess that is our last question, Professor. Do you have any final comments?
Yes. So thanks a lot for joining me today, and I'll be very happy to accept any questions in the future if you have. Again, I think I said many times, I think a vaccine is very important. If we can if we can help the emerging markets to access vaccines faster and earlier, that's helpful for emerging markets. Is also definitely helpful for the global economy.
Okay, thanks, Professor. And thank you all who came and raised nice questions. I'll turn it over to John to close the event. Thank you all.
Well, thank you, Professor Bai and Chung, for the engaging and informative session. And thanks to all of you for joining us today. We hope you enjoyed the program, and we would like to hear your feedback. So please take a moment to share your thoughts about the session through a brief anonymous survey. The link to the survey will appear on your screen at the end of the webinar. Select Continue to get to the survey. And please join us on Thursday, May 27th at noon Eastern for our next Experience Rochester lecture titled The Inner Light, the Beatles, India, Gurus, and the Legacy, featuring Professor John Kovach. That's all. Have a great afternoon, everyone. Thank you.